Protecting your 401k in trying times. We are living in a very challenging time. Inflation is up. The stock market is down. The Federal Reserve is raising interest rates. And cryptocurrency is melting down. The real estate sector remains strong. But is there a lag in the market? Will more potential interest increases destroy that market too? Will the Russian-Ukraine war cause further fuel supply disruptions? When all is said and done, how do you protect your retirement? Whatever decision is made, there is a strong possibility of short-term financial pain. According to Bank of America, if you had put $10,000 in the stock market in 1930, the value of that investment would be worth $1.78 million today. However, if you had missed the top 10 gaining days each decade, that investment would only be worth $12,800 today. Even more shockingly, the largest gaining days on the market took place within 10 days of the most significant sell-offs. So, as hard as it may be, the best long-term approach is to stay the course and continue to buy into the stock market. The Consumer Price Index, a measure of inflation, has been 8.5% and 8.3% over the past 2 months, far above the 2% to 3% increase that most economists generally desire. Not surprisingly, food, gasoline, automobiles, and plane tickets have been the most significant drivers. The federal government ran a deficit of $3.1 trillion in 2020 and $3 trillion in 2021. These deficits are more than triple the deficit for 2019. These deficits now equate to 15.2% of GDP, the highest rate since 1945. The COVID pandemic of 2020 and 2021 caused a slowdown in the economy. Stimulus checks and federal and state unemployment relief programs were unseen factors causing the deficit to skyrocket. The Federal Reserve lowered its lending interest rate to 0, which kept the economy liquid. And the overall slowdown in the economy kept inflation relatively in check. However, disturbing signs began to manifest themselves in 2020, which are driving forces behind today's high inflation levels. Raw materials such as copper, up 25.8% in 2020, and 26.8% in 2021. And steel, up over 200% since 2015, have skyrocketed, causing shortages, particularly in finished goods. Items such as propane tanks, computer parts, and auto parts may have delivery times as far as 1 year into the future. This, combined with Russia, the world's largest exporter of petroleum, having sanctions placed upon them for the Russian-Ukraine war, has been a significant contributor to gasoline prices skyrocketing to all-time highs. These increased costs of raw commodities have reverberated throughout the economy, causing hardship for poorer and middle-class families. The real question is the price of raw materials increasing? Or is the dollar's buying power decreasing? Either way, the solution to curb inflation and increase the dollar's buying power is to raise interest rates. However, raising interest rates will most likely have serious adverse effects on certain sectors of the economy. Real estate, the only sector remaining on positive ground, will likely have a drawback. The real estate market generally lags behind all other economic sectors. The duration of time in buying and selling homes has an extended period before the asking price of homes changes. If speculators have been taking advantage of lower rates and low down payment amounts to purchase rental homes, we may see a repeat of the Great Recession of 2008, where excess property inventories fueled downward price momentum, causing mortgages to be more than the value of these houses. Unfortunately, there is no easy answer to curing the inflation problem. In retrospect, the Federal Reserve lowering its lending rate to 0 was an extreme remedy, but the COVID pandemic was an extreme situation. However, the preliminary warning signs of skyrocketing raw materials prices should have triggered a monetary tightening policy. Interest rates needed to be raised before inflation reached these levels. It now appears that we will still be paying for the costs of the pandemic for some time. The crypto market is still in its infancy and may be the next evolution used to pay for goods and services. When cities first came into being about 10,000 years ago, most trading was done by barter. The problem with barter was that both parties needed to have the same needs. As time passed, coins made from precious metals, mainly gold and silver, replaced the barter systems. Eventually, paper money backed by governments replaced coins. When paper money was introduced, business and personal checks soon followed. A check is a piece of paper issued from a bank account, accepted as payment, and guaranteed account holder's signature. The next step in this evolution of prices was credit and debit cards. Now, a credit card account number is a generally accepted form of payment. Furthermore, it is now commonplace to have recurring deductions directly from the individual's bank account. Many companies have gone to direct deposits for employee paychecks. Or if there is still a physical check issued, it can now be deposited by taking a picture of it on your phone. The use of automated payment systems has resulted in many people just reviewing their transactions in their bank account, as deductions and deposits are automatically performed for them. The critical development in currency is trust. Can both the buyer and sellers believe that the payment they are receiving represents the same price? The barter system had minimal confidence. Precious coins had more. Once government-backed currency appeared, most people never gave a second thought that paper money could be worthless. Checks and credit cards drawn off financial institutions never caused concern about the value of money not being what it was stated. Cryptocurrency is the next logical step forward. In reality, many people's bank accounts are already similar to a digital wallet. Money goes in and comes out without checks or cash. Transactions appear on your bank account from direct deposits, debit cards, and automatic payments to utilities and other recurring vendors. Crypto is short for cryptology, which is a digital ledger. Similar to a bank, an individual's cryptocurrency balance is tracked on hundreds of thousands of decentralized computers that independently verify crypto hashes to identify whether the user's digital wallet is sufficient to complete the purchase. Since independent computers perform all balance verification, it is practically impossible to hack the network, as the hacker would have to hack hundreds of thousands of non-affiliated computers. This decentralized network uses blockchain technology to access more resources when the volume of transactions increases. In many instances, the transaction processing time is less when more users access the system. Even though the transaction history is safe from hackers, individual accounts on the exchanges are targets. Proof of ownership is verified with a private key. If a hacker identifies your private key, they could steal your currency. It is recommended that you store your private key in a digital wallet, preferably a cold storage wallet that uses a device similar to a USB stick, which prevents access to your crypto account by using the internet. The most significant problem facing the crypto market is that it is not generally accepted as payment, at least in the United States. In the United States, Amazon, Burger King, and Starbucks all agreed to accept cryptocurrency and then subsequently changed their mind. In all likelihood, this was done due to the market's volatility. Imagine sending $15 for a pizza, only to find out 3 months later that the cryptocurrency you used is now worth $200. Or if you were the seller, and you find out that the $15 you received was now only worth $5. So, if crypto cannot be used as cash, is it just a poker chip? A bet on the market. One of the strongest arguments for crypto is that it is a hedge against inflation. However, it has not behaved that way recently. Or has it? The value of cryptocurrency is its decentralized nature, which allows its availability to be used worldwide. Countries like Vietnam, Venezuela, Argentina, Turkey, Nigeria, and Kenya have all experienced periods of hyperinflation. When viewed in a longer-term scope of 5 years, crypto has been excellent protection against inflation in these countries. In fact, it is generally more desirable by the residents of these countries than their country's actual currency. In an effort to have crypto more accepted in countries with a stable currency, the crypto financial system came up with various crypto coins called stablecoins in an attempt to instill more trust in the system. These coins are generally pegged against a currency: the dollar, the yen, the euro, to prevent price fluctuations between the seller and consumer and hopefully instill the needed trust in stablecoins. These stablecoins are offset by collateral using algorithms or the actual currency of the stablecoin. It is worth noting that cryptocurrencies may be perceived as stocks, and although they may sometimes behave similarly, they are not stocks. They are currency. An algorithm protected Terra's USD coin, whereby its sister company Luna worked as a stabilizer bar to Terra's USD coin. The holders of USD coin were paid an interest rate of 20%. And the value of the coin was pegged at $1. Unlike prior stable currencies, Terra Luna had developed an extensive ecosystem that promoted the USD coin for receipt and payment for goods and services. Like credit cards, the USD coin charged interest rates to businesses typically much lower than those set by credit cards. Most of the holders of USD coin had faith in the coin, and since the price of the currency was pegged at $1, they were not speculating on future profits but instead viewed their investment as fixed and safe. The algorithm used to provide stability to the coin was a trading technique known as arbitrage. An arbitrage play is when a trader can simultaneously buy and sell a stock for a profit. On the New York Stock Exchange, arbitrage plays most frequently occur when a company, or a segment of a company, issues new stock, and traders take advantage of the short-term volatility of the stock by purchasing the IPO issuance and then immediately selling it on the exchange. The logarithm used by USD coin was an arbitrage play that operated as follows. If USD coin traded below $1, owners of USD coin were able to purchase a Luna coin for $1, and the USD coin would be burned, and Luna would mint a new currency. Theoretically, lowering the number of USD coin would exert upward pressure on the USD coin, bringing value back to $1. Conversely, if USD coin traded above $1, the arbitrage play would be to purchase Luna for $1 and immediately sell it to USD coin for the price that it is trading for over $1. Luna would burn a coin, and USD coin would mint another coin. Reviewing the evolution of currency, we can see that the most critical element with money is trust in the system. Once that trust is lost, people panic and try to preserve whatever wealth they still have. The worst-case scenario for a stable coin using this algorithm is panic. This panic creates a situation whereby both coins are being sold simultaneously. On April 22, 2022, Luna was trading at $117 per share. On May 17, 2022, it is trading in mils at slightly higher than 1,000th of 1 cent. Luna's market cap before its meltdown was $74 billion. To put this in perspective, Enron's max market cap was $90 billion. However, the day before Enron's stock imploded, Enron's market cap was $70 billion, $4 billion less than Luna. The resulting arbitrage play between USD coin and Luna caused Luna to mint so many coins that they have over 6.5 trillion coins outstanding. Conspiracy theories about market manipulation abound. The initial rumor was that when USD coin first became unpegged around May 6, 2022, Luna purchased $1.5 billion of Bitcoin to collateralize Luna, enabling USD dollar to maintain its peg. On May 13, the attacker or attackers shorted Bitcoin for $300 million, placing seller pressure on the entire cryptocurrency complex and drying up liquidity. Bitcoin's trading price dropped by 20%. For simplicity purposes, a short is selling a share or coin without owning it, with the hopes of repurchasing it at a lower price in the future. The process is much more complicated, but the concept is important, not the mechanics. Then an additional short of $650 million was placed on USD coin, causing it to lose its peg and spiral downward as the arbitrage play trying to maintain USD coin's peg accelerated. As Luna's minted more coins, the coin value began a precipitous drop and eventually created a death spiral when traders began selling both Luna and USD coin. On the surface, this rumor doesn't seem plausible for the following reasons. 1. A $950 million short should not be able to destroy a company with a $74 billion market cap. 2. The emergency worst-case scenario collateralization used to support USD coin should have come from a different sector other than cryptocurrency. Since the USD coin had a fixed price of $1 and a set interest rate, there should have been a fail-safe procedure to protect the users of the currency. For example, suppose there was a procedure to halt trading for an extended period once the peg was broken by more than a certain amount, thereby allowing the pegged coin to be recollateralized before selling accelerates beyond the point of no return. 3. As more information has become available, it has been verified that $3.5 billion of Bitcoin, Avalanche, Luna, and USD had been stockpiled to protect the USD coin peg. The lingering question concerning this is, were all of these stockpiles used to defend the peg? Regardless, trust was lost in the system on a coin that's purpose was to instill confidence in the system. Many people lost their life savings, and a few people made millions, if not billions. George Carlin said it best. It's a big club up top, and you're not in it. It is estimated that 90% of traders lose money. If this was market manipulation, it is more critical for stablecoin algorithms to have enough fail-safe solutions to prevent this disaster rather than if a few bad actors contrived an elaborate attack. The most significant problem was the stablecoin did not account adequately for a massive short attack. The next hurdle for crypto is government intervention. Both sides are lining up for long court battles due to the events of last week. The New York Mercantile Exchange came into being in 1882. One of the earliest issues they had was that the buyers of physical products would create roadblocks preventing farmers from delivering their products to market on time, thereby incurring additional costs and fees. There will always be bad actors that will exploit weaknesses in systems regardless of the ramifications to others. Crypto has only been around for 13 years and has been incredibly successful no matter what yardstick you use. But you don't know what you don't know until you learn it is a phrase that fits the events involving Terrell Anna. At this point in crypto's life cycle, any investment should be viewed as speculative, and any investor in crypto should realize that they may lose their entire investment. Hopefully, what comes out of this debacle is that modifications are made to ensure the public can trust the crypto market segment. So what is the best course of action to protect your retirement funds? Everybody's retirement situation is different based on their age and years left before the need to access these funds, and the amount of money, if any, be still being placed in retirement plans and 401ks. For purposes of this article, investors view their portfolio using a 5-year or longer approach in regards to profitability, whereas traders use daily and short-term approaches to their investment strategies. If you are currently retired or have less than 5 years before retirement, you should be more conservative than somebody in their 20s or 30s that have 40 years to go before retirement. Referring back to Bank of America's analysis of the stock market, if you had put $1,000 in the stock market in 1930, the value of that investment would be worth $1.78 million today. However, if you had missed the top 10 gaining days each decade, that investment would only be worth $12,800 today, with the most extensive gaining days taking place within 10 days of the most significant sell-offs. If you are retired or close to retirement, you should ensure that the gains and losses in your account haven't created a situation whereby one area has substantially higher allocations than others. If you are fortunate enough to have invested in real estate or REITs, this area could be up as much as 20%, while at the same time, your tech stocks may have fallen by 38%. The Federal Reserve may have as many as 7 interest rate increases in the upcoming year. Consideration should be given to reallocating your investments in REITs or other real estate-backed investments. It is not the largest component of your portfolio until the Federal Reserve announces that it is stopping future rate hikes. 1. If you have 100% in real estate, consider lowering that to 50% real estate and 50% index funds. 2. If you have 50% in real estate, consider lowering it to 25% and investing 25% in index funds. 3. If you have 25%, only a mild reallocation needs to occur. Stand pat or consider selling 5% to 10% of the real estate assets and invest that money in index funds. Only 2% of Americans are invested in cryptocurrency, and many 401ks do not provide the options of trading cryptocurrency. However, considering placing a tiny percentage of your total portfolio as a guard against future inflation is not a terrible idea. Cryptocurrency is a highly speculative play, and you must be aware that you are risking losing all your money placed in the sector. Still, a small amount of risk can provide more stability to your retirement than having all safe assets running in tandem with other investments. Bitcoin is the largest cryptocurrency and has had market caps in excess of $1 billion, so it would seem unlikely that any investment in Bitcoin would lose its total value. But nothing is impossible, so your mindset going in should be that you can lose all your money in this investment. For the age tier that is close or already in retirement, only a tiny percent of total holdings should be placed in crypto, 3% or less. More importantly, due to extreme volatility in this sector, you should always reallocate your asset mix to keep crypto at 3%. For example, if all your other assets drop by 20% and your crypto stock increases by 100%, your crypto percentage would be much higher than 3%. At this point, you should lower your crypto back to 3%. If, after doing this, profit-taking, your crypto stock decreases to 1%, you should consider taking some of the profit you made on crypto and bringing the crypto investment back up to 3%. For investors who have more than 10 years to go to retirement, the most critical aspect of investing is to continue buying into retirement savings plans. If your company offers incentives to join a 401k, you should take advantage. Depending on the size of your portfolio, short-term losses in the market may be more beneficial to you than a rising market, as you are cost averaging in, and the percentage of these stocks versus your total portfolio should be much higher than someone that has been saving for 20 years or more. Suppose you are in your 20s and 30s and have not purchased a house yet. In that case, you should consider lowering 401k deposits to a level that obtains all incentives offered by your company and save the remaining amounts for a down payment on a house, as the money you've saved in your 401k will incur penalties if you need to access these funds. Cryptocurrency for this group is still a very speculative investment, and you need to be prepared to lose all money you have invested. It is unlikely that your 401k plan would offer a crypto option. But if it does, you should limit it to a reasonable amount to start and diverse down when you reach the point where you have 20 years left to retirement. This article is to be used for educational and entertainment purposes only and is not to be used for investment advice. The author has held senior accounting positions for over 30 years and has hedged over $1 billion on the New York Mercantile Exchange.